This is Jay Martin.
It's always fun to chat with the both of you. I've had you both on my podcast many times, and I love it when we get to do this in person. For anybody who's not familiar, though, I want to do a quick self-intro. So in 30 seconds or less, Scott, Amir, could you introduce yourself? Who are you, and what do you do? Scott, I'll begin with you.
Well, thanks. I'm Scott Melbye. I'm CEO of Uranium Royalty Corp and Executive Vice President of Uranium Energy Corp. I'm in my 39th year in the uranium and nuclear energy industries, having worked in everything from nuclear power plants to trading uranium to working for 3 of the 4 largest producers, uranium producers in the world, in global marketing executive positions. So very excited to talk about uranium today at a very pivotal point in the market. Appreciate that, Scott. Thank you. Amir.
Hey, before I talk about my background, can we give a big round of applause to Jay and Cambridge House and the Martin family? This conference and your family have such a special place in my heart because as an entrepreneur from Vancouver, 20 years with your dad starting this thing and you kicking it to a whole new level this time of year, this is such a beautiful way to kick off the year. And honestly, you guys do an amazing job. I'm really proud of calling this conference home to Vancouver.
I appreciate that, man. It means the world. Thank you. And turns out it's super fun.
It is a lot of fun.
What a benefit.
I'm a Vancouver-based resource entrepreneur, UBC grad, interested in the 2 yellow metals, gold and uranium, and have been active in the uranium industry since starting Uranium Energy 18 years ago. We were told when we attended these conferences that Rick Rule would speak and Frank Holmes would speak, and they would say, well, the commodity business is cyclical. You'll have 4 good years and 3 bad years and so on and so forth. Uranium, we've had 15 bad years in the last 18 years I've been in it, and 3 good years. And so it's been just a horrible nuclear winter, and it really feels like we're turning it around, but I'm sure we'll talk about that.
Yeah, we're going to talk about that, and we're going to talk about how you stayed busy during those 15 bad years and positioned yourself accordingly. So Scott, I want to start with you. There's not many veterans in this business, if any, who have seen the market from as many angles as you have. Now, we can host, I was just saying, a uranium feature on this stage every year, and people show up bullish on uranium, but this year, things look a little bit different geopolitically and from a demand and a supply and demand standpoint. So what is catching your interest right now that strikes you as different and substantial? Sure. Well, I'm guilty of being a perma-bull in uranium, but I do watch the fundamentals very closely, and I kind of compare them to where we've been in previous cycles. And I will honestly say with complete conviction that I'm more optimistic and more excited about the uranium fundamentals today than I've been in 40 years in this industry. And it's based on very basic fundamentals of supply and demand of uranium. Certainly the megatrend towards green energy, which has really driven the acceptance of nuclear power and see growth in demand for nuclear power, growth in demand in uranium like we haven't seen in many years. And then the geopolitical developments that we'll touch on where potential ban on Russia and difficulties that the world's largest uranium producer in Kazakhstan is facing getting materials to the Western market. So again, a lot of your previous panelists touched on it. I mean, we're an industry that has a 50, 60 million pound gap between production and consumption, and we have been in this position for several years. I know in previous conferences we had said, be patient, the market's rebalancing, inventories are being drawn down, but hang in there. I've just left the World Nuclear Association Supply and Demand Working Group meetings that are putting out the World Nuclear Association report on uranium in September. And with almost unanimous consent, there is a conclusion that everyone's coming to that this transition from an inventory-driven market, which has been the case in uranium for decades, we've now transitioned past tense to a production-driven market. And that has huge, profound implications because the next marginal pound that supplies the market going forward is coming from a mine that has production costs, permitting, licensing, lead times, all that stuff that matters in normal, efficient commodities is going to matter in the uranium market. In the past, it was always an inventoried pound that met the gap, and there was obviously significant inventories because this gap has existed for many, many years, and the market has struggled to recover. But
Going into 2023, I think is a very different situation where the availability of mine production and the cost of that production is going to drive uranium prices.
Thank you, Scott. Now, Amir, when you look globally and you look at the conflict in Europe, when you look at the activity in Japan, when you look at promises elsewhere to ramp up production of plants, what catches your attention, either geopolitically or from the demand side right now, that you're like, that's real and that's different?
Well, I think it's real when it hits home every month at the end of the month when you pay your bills. When you speak to your friends or colleagues or anyone in Europe right now, they would tell you their power bills on a month-to-month basis have gone up from 100 to 400%. It starts to really make you think when your power bills are equaling the cost to service mortgage or to pay rent. And this is what's happening in Europe. This is what's happening in the UK. This is what's happening in Western Europe. And so in a way you could argue that the energy markets and the uranium market and the nuclear energy market is very much tied up with the humanitarian crisis that's going on in Ukraine. Russia's invasion of Ukraine has absolutely been a game changer for everyone waking up and realizing that we cannot rely on Russia as a normal counterparty. I think the issue is that there was some normalcy and some complacency that had really settled into the West and thinking that Putin would just be reliable and normal. And for the foreseeable future, we're talking for generations to come, there is a movement afoot to diversify away from Russia when it comes to energy supplies. And this is an important trend to pay attention to, a geopolitical trend that happens to coincide at the exact same time that we have decarbonization and electrification as two other very important trends underpinning what's driving the acceptance of nuclear energy. I have never seen so much acceptance for nuclear energy in the 18, 20 years I've been doing this. And I've never seen the customer, the utility companies that need the uranium for their power plant in such great financial shape. You see, the utilities can no longer complain about financial hardship because they used to do that for years. Because of the stimulus bill and the infrastructure bill and the Inflation Reduction Act, they have been given billions of dollars of tax credits or other support, finally recognizing the fact that they're baseload electricity, but emission-free baseload electricity. So now, the biggest term that I actually haven't heard anyone talk about, even on the last panel, is price inelasticity. It's a wonderful thing when you go into a recession and you have a product to sell where the customer is not price sensitive. And it really doesn't matter if a utility pays $50 or $200 a pound. It makes less than a 5% difference in their total cost to run that nuclear power plant. That could be a reason why days like today, when the Dow Jones and the S&P 500 are down and they're red, you see the uranium sector up and green. There's a decoupling going on. And it's a decoupling that the market realizes that whether we have a recession or not, whether we have rising interest rates or not, we have a sector that's been in the toilet for 15 years that is finally coming up because of three important global mega trends are converging, including the world's largest supplier of uranium being completely unreliable, that being Russia. And the next realization is this. For the last decade, the industry globally kept building nuclear reactors. Over 60 reactors were built over the last decade and brought online. You know how many uranium mines were built in the last decade? Take a guess. Between 0 to 2. One major new uranium mine was built over the last decade, the Husab mine in Namibia. So when you think about supply-demand, the supply expanded by the margin of one mine and demand kept growing to the tune of 60 new reactors coming online. So the industry that builds the demand side of the equation didn't disappear. But the industry that has to build the next generation of uranium mines has really been decimated. We're seeing that firsthand when you're out there and you're like looking at stats and you're realizing there used to be tens of thousands of people working in the uranium mining industry, and today we have hundreds of people working in the uranium mining industry. What that really tells you is that higher prices will obviously cure the problems that I'm outlining, but I think we're going to see prices that will be far beyond anyone's expectation, because we need to see enough incentive and incentive levels to see the next generation of uranium mines get built.
I love that. Thank you, Amir. And by the way, 18 years with UEC. It's amazing. All right. Scott, I want to come back to you.
Yep.
If there's something you wanted to add on there, go for it.
Yeah, well, just, geopolitically, obviously we're focused on Russia, and as the head of the Uranium Producers of America, I think, we see it firsthand with efforts in the US Congress and House to ban Russian uranium. It hasn't happened yet, but whether you're Senator Barrasso or Senator Manchin, we all agree that we need to stop the $1 billion a year going to Rosatom for US Russian uranium purchases. It's 25% of our uranium enrichment comes from Russia, but one thing you shouldn't forget is 50% of our uranium in the United States, for 20% of our electricity, comes from Russia, Kazakhstan, and Uzbekistan. And whether Russia's banned or not, listen, we're moving away from Russian involvement in the Western nuclear fuel cycle. Don't take your eye off of Kazakhstan. Kazakhstan is not sanctioned under Russian sanctions, but they might as well be. All of their uranium has to be transported out of the port of St. Petersburg. It took 1 year for Kazatomprom and their partners in Kazakhstan to get one shipment out the Caspian Sea through Azerbaijan, Armenia, into Turkey, and out of Black Sea port. I remember the last bull market. Remember, demand was increasing like it is today. Investment was we hadn't seen investment in the fuel cycle and uranium mines for many, many years, like we have seen in the last 10 years. But we saw supply disruptions, and at that time it was Cameco's mines, Cigar Lake, MacArthur River flooding. It was Olympic Dam, fire at their mill and smelter. Well, this time, what's the impact of the world's largest producer producing 60 million pounds out of the 130, 140 million pounds we produce annually? What happens if they can't get any of their uranium or meaningful quantities to Western markets? And I'm also sure that Russia, who is under sanctions globally, is going to covet the uranium in Kazakhstan. And not only does Putin need that uranium from Kazakhstan, President Xi from China shares another border on the other side and is the fastest growing nuclear market in the world. Why is that important? It doesn't change the global supply and demand balance, but it does create a shortfall in the Western markets in Europe, United States, Canada, and Asia. So keep an eye on Kazakhstan. This is a really big impact that could be one of those supply disruption drivers that really sends things heading upwards in 2023.
Okay, now thank you, Scott. Now you're both building companies in this arena, and you eat your own cooking, major shareholders of your companies, of course. Scott, you run Uranium Royalty Corp. It's the world's first and only pure play uranium royalty company. Can you walk my audience through the business model?
Yeah, so we basically saw the incredible success of the royalty and streaming model in base and precious metals. Companies like Wheaton Precious Metals, Franco-Nevada, they've become such a key component in project mine development, a source of capital that comes alongside debt and equity for miners and developers to get into production. We were amazed that no such company existed in the uranium space. So we launched first 5 years ago on the TSX, on the NASDAQ exchange a year and a half ago, and are off and running with a portfolio now of 18 royalties in a very young company, but with significant assets like Cigar Lake, MacArthur River. We have interests in the Langer Heinrich mine in Namibia. We've got US ISR projects like Lance and Peninsula. And we've got physical uranium that we've put into a portfolio and bought at the bottom of the cycle. What I'm most excited for, though, is those were royalties that we bought from the secondary market. Our discussions that we're in with potential counterparties now are as a source of project capital for new mine developments. I believe that probably with Cameco producing at full capacity and the Kazakhs producing it at their levels, we probably need 8 to 10 new uranium mines coming online globally in the second half of this decade. UEC is going to be part of that with mines in Texas and Wyoming. But URC wants to be the capital provider to the other companies that fill that universe of new mine development. And billions of dollars are going to need to be invested in this space. We want to capture a portion of that in royalties and streams.
Okay, thank you, Scott. Now, Amir, I want to talk about Uranium Energy Corp. I'd love to have you outline the business model. This is the second most liquid uranium stock, second to Cameco, just for some context. walk my audience through the opportunity and how you stayed busy, because I look at your M&A spend, like how you've invested in growth over the previous 6 months alone, right? You're very aggressive. I know that about you as an entrepreneur, with your gold companies too, very aggressive in down markets. So what is UEC? Walk us through the opportunity, and what are you looking forward to?
Well, I'm a Canadian. They say Canadians are nice and polite, but they forget we can be aggressive as well, right? And so UEC really is a company that was a business plan in 2005. And it was a business plan to basically build a US uranium producing company. And the reason for the US side is I looked at the market, realized the US was the world's biggest consumer of uranium, but hardly producing any mines. And historically used to be the world's biggest jurisdiction for production. And we started with very humble beginnings, but exciting low-cost production in South Texas. And we got into production from 2005 to 2010. We achieved production in 5 years. Fukushima happened in 2011. Uranium prices were falling, and we had to shut the production down. We reassessed whether we thought the nuclear industry was going to die or if this was just going to be a bear market. Concluded it was going to be a bear market, and that the best time to make acquisitions, the best time to buy your Christmas decorations is January, right? That's our belief. So we felt, let's go and make acquisitions, 10 cents on the dollar type of growth. And we expanded the company from having just a portfolio of assets in Texas into Arizona, into Wyoming, into South America. In the last 15 months, we decided to get even more aggressive with acquisitions. And we acquired Uranium One from the Russian government. That was before their invasion of Ukraine. We started to stockpile physical uranium. And after Russia's invasion of Ukraine, our feeling was that North America as a whole, not just the US, was going to really grow significantly in order to replace the vacuum of having to get off of Russian material. The difficulties that Kazakhstan is going to have getting uranium to the market that Scott spoke to means we need more Canadian mines. We need more American uranium mines. So UEC in the last 12 months has really built a two-pronged approach in our business. We have low-cost in-situ recovery production in the US, fully permitted, built, production ready in Texas and Wyoming, and combining that low-cost in-situ recovery in the US with the best-in-class conventional mining in Canada. The highest, richest Canadian uranium deposits, richest in the world, are in Athabasca Basin in Saskatchewan. 100 times the average grade of uranium in the world. And so this is the 1-2 punch that UEC has created. We acquired the Roughrider deposit from Rio Tinto. Many of you here may have been shareholders in Hathor. That was acquired by Rio Tinto in 2012. And we acquired another public company called UEX. Today we have the second largest portfolio of resources in North America after Cameco, second most liquid, as you pointed out. And we're 100% unhedged. So if uranium prices go to $200 a pound, we want to catch every bit of that upside. And you know, the UEC journey really hasn't ended yet, because I don't believe the uranium bull market has started yet. The uranium bull market doesn't start when uranium's at $50 and companies aren't building new uranium mines. The bull market starts when companies globally can economically justify building new uranium mines. And the trigger with that, for that, is going to be $70, $80, $90 a pound, not $50 per pound.
I love that. And I want to walk through how you acquired the Roughrider deposit. You touched on the fact that you were stockpiling physical uranium, which is the definition of eating your own cooking as a uranium company. You're able to leverage that into the acquisition of the Roughrider property, correct?
Yeah, so we were buying physical uranium starting at $27 per pound. And we were doing that because we believed uranium prices are going higher, and price at 27 was less than cost of production. When Rio Tinto decided to sell Roughrider because it was simply too small for Rio Tinto, which is now a $90 billion company. Rio Tinto has a market cap that's 4 times the combined market cap of the entire uranium sector. And so even a world-class deposit like Roughrider was too small for them as they got bigger in iron ore and lithium. And they didn't want to mess around with any company taking time to pay them in cash. We were able to take profit out of our physical portfolio, give them basically a fully financed acquisition, combined with cash on hand that we had, And in fact, I believe we were able to buy that deposit at $150 million, $100 million less than what the next bid was, which was subject to financing, and $450 million less than what Rio paid for it in 2012, which was $600 million. So again, this is the moment in time to get the deals, whether it's buying the assets or where the equities are being valued in the market for uranium right now. And 2 weeks ago, I was blown away when we were in London marketing to institutional investors. And I can tell you right now, if there's one thing you got to take away about uranium investing, the largest mining-focused funds on the planet do not own uranium stocks yet, not even Cameco. And so there is an incredible amount of underweight profile amongst mining-focused funds. Forget generalists. The dedicated funds do not own uranium yet, the largest ones. To me, that's a major takeaway. And anyways, I'll stop there. I know we're over time.
Yeah, but that's really important context. Look, I appreciate both of your time. Thanks for coming up on stage and speaking with me and getting in front of my audience. Thank you.
Thank you, Jay.
Thanks, Jay.
This is Jay Martin.